We have with us Mr. Maneesh Dhangi, CIO Debt, Aditya Birla SunLife Mutual Fund. While most investors today do understand about equity, but the same thing cannot be said about debt. There is terms like duration, yield, is something which is difficult to understand for a lot of investors. Can you simplify this for our investors?
Frankly, fixed income funds should be simpler to understand than equity, but I guess investors are simply coming to know of it in recent times, and therefore it's on to us to sort of explain what these funds mean. So if you look at variety of asset classes that investors or savers sort of put their money in, people understand real estate, people understand equity and equity mutual fund, but people also understand fixed deposits. Now, fixed income funds characteristically are very close to fixed deposits. So I mean that is what should anchor investors when they invest in fixed income funds. They behave somewhat like fixed deposit. Now, typically equity and real estate, when you invest in, large part of your returns are made from growth, not the yield. So when you invest in real estate, you earn, let's say, 1.5 or 2% in terms of rental yield, but majority of your returns come from the growth of property prices. Similarly, in equity, you earn 1.5-2% of rental yield or dividend yield, and then rest comes from the growth of the company and the stock prices. Whereas in fixed deposit, majority or rather all the returns come from the yield itself. So going back to your question of fixed income, first of all, anchor your thoughts to fixed deposits. Okay, it is somewhat like fixed deposit. Majority of your returns are likely to come from the point of view of yield. In a sense, they are in the beginning when you invest in a fund. Okay, it will tell you that what is the yield it has. Let's say a typical short-term fund right now has an yield of 7%. What it demonstrates to you is that over a period of, let's say, 1 year, you're very likely to earn 7% return if interest rates do not go up or come down in a meaningful fashion. Okay, so that's the meaning of yield. Now, what is the duration? The duration is, though it is a weighted average maturity, but from an investor point of view, what it means to the investor is the risk in the fund when the interest rates rise or fall. So please understand that when you invest in a fixed income fund, or let's say if it runs at 2-year duration, what it means is that if the interest rates go down by 1%, then you are likely to earn 2% of capital gains. Okay, so let's say if you invest in my short-term fund, it has a yield of 7%, and interest rates tomorrow fall by 1%. Then over a period of, let's say, 1 year, you're likely to earn more like 9% on a yield of 7%. And vice versa. In interest rate, let's say, go up by 1%, then you're going to lose 2%, and your returns for next 1 year would be not 7, which the yield told you, but 7 minus 2% because that's the loss because of the duration risk. So broadly, yield and duration, these are the two characteristics of a fund. When you don't know anything else about the fund, these two essentially tell you, the kind of return that you would earn from that particular fund over a period of 6-12 months.
As you talked about the risk in the funds, can you just take us through what are the risks attached to debt funds?
So a typical mutual fund in the fixed income space would carry two risks. Okay, one we recently discussed, duration risk, which essentially means that if interest rates in India sort of go up, then your returns will go down, and if they come down, your returns will go up. Now, it is inversely related with interest rates. So because why? Essentially, if the interest rates are going up, then your original investments are getting marked to market at higher level, and therefore, at least in near term, there will be losses. Okay, or the overall yield will come down, the experience yield will come down. So that's one risk that you run. Second risk that you run in a portfolio, fixed income portfolio, is the credit risk. Essentially, what does a fixed income fund do? When you go to a bank, what is that you're looking at? You're looking at the kind of bank that you're investing in. If you invest in a good bank, then you're very likely to sort of get a fixed yield in 1, 2, 3 years, whatever horizon you're investing your money in. But if you invest in a bank which, let's say recently a bank had a run, okay, a cooperative bank went down, Now all the money that you had invested, you lost money there. So typically that's a credit risk. Now a mutual fund portfolio also invest in tens and 50s of such security. A typical portfolio will have 50, 100 securities. Okay. Now what are those securities? These are securities where the investment is made to certain companies. If those companies actually do not return money in time, then this tantamounts to some losses in the portfolio. So these are the two primary risks a mutual fund runs. Now let's actually discuss the real thing. Majority of investments in Indian fixed income funds are actually invested in AAAs and AA security. Let's say more than 95% of the total investment is in AAA and AA security, where the risk of default or loss given default, okay, is very, very low. So therefore, most of the times, for most of the investors, credit risk actually does not materialize in a meaningful fashion. Yes, interest rate risk is for real, but as long as investor is investing in right mutual fund, okay, then the interest rate risk also does not materialize in a meaningful fashion. Again, to give you a corollary of fixed deposit, let's say if you have investment to be made for 3 years, okay, then you must invest in a 3-year fixed deposit. But if you want money within 3 months, and if you invest in 3-year fixed deposit, what will it mean? After 3 months, when you actually break the FD, you will have to pay a substantial price to the bank, in terms of penalty. So somewhat similar, in mutual funds also you have many funds, at least 8-10 kind of funds are there, which are broadly placed for variety of investors for variety of investment horizon. So if you have a 1-day or 2-day horizon, you have one certain kind of fund. If you have a 3-year horizon, you have something else. Okay. So as long as you invest as per your requirement and identify a right fund, then investment risk actually for most of the funds do not materialize in a meaningful fashion for the investors.
We see so many categories within debt funds as well. Can you help us simplify these categories for us?
Essentially, fixed income basis your investment horizon offers you various funds. Okay, as I discussed just about a minute ago, that the risk can be contained for you as long as your investment is made in the right fund. Then investment risk or interest rate risk do not materialize in a meaningful fashion if you are investing your money in right category of fund. So there are funds which are dedicated for investors who want to park their money or invest their money or save their money for only few days. Okay, then they are overnight and liquid funds. If you have a 7-day money or 15-day money, why let it stay idle in a savings deposit and earn 3% return? Okay, why not invest in a fixed income fund and maybe earn 5, 6 or 7% return, depending upon what kind of investment or interest rate scenario is there in the country right now. They are pretty much a fixed dish return, on a daily basis, and rarely you lose money in these funds. But if your investment horizon is somewhat longer, let's say you want to park your money for 1 month or 3 months, then you have these liquid plus funds, funds like ultra short term fund, money market, or low duration funds. So these are the funds which sort of cater to investors' need of parking their money for longer than 2-3 months, maybe up to 1 year. Okay, so they are good alternatives to short-term fixed deposit. Anything which is 3 months to 1 year fixed deposit, these money market, ultra short-term or low duration fund would very likely do better than them. Okay, then there are third categories of fund which are, you could call them investment products. Okay, they actually compete with long duration FDs. Large amount of your money which you have a sight of in terms of it's going to be there with you for next couple of years. You don't need that money. Now, should you be investing that money in liquid fund or liquid plus fund? No, you should be investing in short term funds. So within short term fund, and I think we'll discuss about it a little later, you have variety of funds in terms of credit quality. You have Banking PSU Funds, short term funds, or corporate bond fund. So they are all relatively good quality portfolios who sort of invest in 2 to 3 year assets and very likely out-deliver fixed deposits of 2 to 3 years. So these are the 3 sort of products which most of them don't run much of a credit risk, and if your investment horizon matches with the specific portfolios that you are investing in, then your overall interest rate risk is also pretty contained. So therefore their behavior or their experience is very likely to be sort of out delivering fixed deposit. After this, there are two more categories of fund where growth dominates and yield also is there, but growth also becomes a significant part of your overall return. One such category of fund is credit fund, which are likely to sort of out deliver short-term fund to the extent of about 2.5% extra every year. But then investor must remember that when they are investing in these funds, they're actually carrying relatively higher credit risk. So it is investing in not on those AAA and AA securities, but it is also investing in A's and BBB securities. So once in a while, when the credit crisis unfolds, some of these companies default, you may end up losing a small part of the extra return that you were earning over short-term fund. But over a long period of time, empirically it's been seen that credit funds are likely to deliver even better than short-term fund. But investor beware that their investment horizon has to be longer, maybe 3 to 5 years in these funds. Then there is the fifth category of funds called duration funds. Those funds essentially are for those investors who want to sort of play the interest rate environment. If you think that India's growth is likely to slow down and RBI is likely to cut interest rates, then maybe duration funds like dynamic bond fund and income fund or gilt fund actually make sense for them, for those kind of investors. Because when the interest rates go down, remember, for every 1% interest rate going down, if you run a 5-year duration, then you will earn 5% of extra gain. So you may have a portfolio which has a 7% yield, okay, and 5-year duration. If there is a 1% drop in interest rates, this fund will actually make 12% return, okay. So duration funds are only for those investors who sort of understand interest rate risk, because it can actually move on both sides, and they want to actively participate in the evolving interest rate scenario in a country, okay. So these are so credit funds and duration funds are for more evolved investors who understand the interest rate risk and credit risk. Those are the only people who should be investing in these two categories of fund. But otherwise, the liquid fund, the ultra short or low duration fund, or the short-term funds or banking PSU and corporate bond funds are for all sorts of investors, and their behavior is very likely to be close to what fixed deposits actually is.
When it comes to investing for 2 to 3 years, you talked about a couple of categories: banking and PSU fund, short-term fund,
yes,
corporate bond fund. So how does an investor decide on these funds, which fund to invest in?
Okay, so we're drilling down now. We started with your money for very short-term liquid fund, your money for short-term, which is 3 months, 6 months, low duration, ultra short-term, your money for 2 to 3 years. Then you have banking PSU, corporate bond fund, and short-term funds. Okay, now your question is, which one amongst these three? So there's a little nuance now. Banking and PSU are the funds which invest predominantly in banks or public sector enterprises. Okay, so these are relatively, you could call them sectoral funds. That only banks. So why did this category come about? Essentially because people think that banks are safe, and of course PSU companies are safe. So if you think that government companies are safe and banks are safe and they are the only sort of funds we want to invest in, then banking and PSU is a fund for you. Then some investors could say that no, I want to invest in a fund which invests in only AAA. So that's a criteria of rating. You understand the meaning of rating? A AAA company is very likely to not default. Okay, we've heard few companies which have gone down in last 1.5 years, but generally a AAA company, if you invest in, you're not likely to lose money. So if you want to invest predominantly in AAA or AA plus companies, then corporate bond fund is a fund for you. Okay, now you may want to say that, look, the way to sort of make returns or extra return is not sort of focusing far too much on only AAA or only banking and PSU companies. Why not invest in good companies, and I want to rely on fund managers and fund houses' ability to sort of understand the credit risk and dial some risk here and there so that I earn a little bit of an extra return. So those are the people, the short-term funds are sort of meant. Now, these short-term funds do not undertake, investment in A-rated companies or BBB rated companies. Okay, they are predominantly AA plus only. Yet, vis-a-vis banking PSU and corporate bond fund, they take some bit of a credit risk, but then there is a commensurate amount of extra return that you get in short-term fund. So basically, banking PSU, corporate bond fund, short-term fund, all three category of funds are essentially for investors who want to invest for 2 to 3 years. That's number one. Now, the categorization, these three different funds are for people who want to run a different kind of credit risk, People who want to invest only in banking and PSU, banking PSU fund for them. People who want to invest predominantly in AAA, AA plus companies, corporate bond fund for them. People who think that no, AA minus, a mix of AAA and AA minus companies actually could, across longer time horizons earn me 50 basis point extra return, then short-term fund for them. But all three funds actually from a duration point of view, duration risk, remember we discussed about duration risk, which is the interest rate risk, they pretty much run more or less the same duration risk, So that's the way you sort of separate these three funds in terms of strategies.
So we talked about 2 to 3 years time horizon, but investors have requirement for just 3 to 6 months time horizon as well.
Yes.
Right? So what kind of funds, as you talked about, needs to be looked at, in the category of overnight fund or a liquid fund? How does that, customers should figure out?
Okay, so look, if your money is invested for very short term, okay, that is, let's say you don't know, you may need it after a week, okay, then you may want to invest in a liquid fund, okay, which is sort of likely to out-deliver a savings deposit by a substantial margin, okay. But if your investment horizon is, let's say, more than 3 months, then as I discussed a few minutes ago, low duration fund or money market fund or ultra short term fund, these are the three different category of fund you could invest in. So essentially, for sort of competing vis-a-vis savings deposit, if your money was lying, your salary sort of comes in and your money is lying in a savings account, for 3 days, 4 days also, if it is earning only 3% or 4%, why not make it earn 5, 6, 7% in liquid fund? Now, if your money is sort of, a lot of bankers would chase you to sort of invest in a 3-month fixed deposit or 1-year fixed deposit. Why not invest that money in low duration fund or money market fund, which are likely to deliver better than a 3-month, 6-month or 1-year fixed deposit, okay? So for them, as I said, low duration or ultra short term fund sort of makes sense. So please understand, again, dominant part of our conversation, in last 20 minutes has been placing fixed income fund vis-a-vis fixed deposits, isn't it? Now, the characteristic of fixed income fund is very much like fixed deposit, but with 1 or 2 or 3 advantages, and I'll sort of try and elaborate on them. One is liquidity. When you invest in a fixed income fund, let's say you may invest in a 3-year fixed income fund, which is, let's say, short term fund, but you may suddenly need after 15 days or 1 year or 6 months that money back. Most of these fixed income funds you should be able to withdraw, so it's very, very liquid. That's one big advantage you have in fixed income fund. The second advantage that you have in fixed income fund vis-a-vis a bank is that fixed income fund is a conglomerate of many companies and banks and many such companies. So remember, we talked about banking and PSU fund. Now, basically, when you invest in a bank, you invest in one bank. Now, of course, very likely that the bank will not go down. But when you invest in a fixed income fund like banking and PSU, you are investing in tens of such banks and tens of such PSU firms. So it's a very diversified fund. And therefore, even if something wrong happens to a specific firm, broadly your investment will not suffer significantly because it's very diversified. That's the second advantage. And the third advantage, especially for long-term investor, is the tax advantage. The tax treatment to a fixed income fund, if you stay invested for 3 years, is significantly better than fixed deposits because you get indexation. So you should talk to your advisor, and he'll help you understand that why the total tax incidence on fixed income fund, if you stay invested for 3 years, is so much less vis-a-vis fixed deposit that it outdoes all fixed deposit, even though they may be delivering sometimes better yield than fixed income fund. So these are the 3 big advantages for fixed income funds.
From debt funds, we move to hybrid funds, and within hybrid, we just would like to know that what strategy does it follow on the debt side, and does it help in creating certain extra alpha for the investors?
So, look, in the hybrid fund, the primary ask of the fixed income portfolio is to preserve and not undertake excessive risk of any kind, be it interest rate risk or credit risk. So the behavior of a hybrid fund, be it regular savings or aggressive hybrid funds like SunLife, Birla SunLife 95, but as such, any aggressively managed hybrid fund, the behavior of fixed income is likely to be close to what a short-term fund does. So basically, run a duration of 1 to 3 years and focus on predominantly AAA and AA securities. So that's the way majority of hybrid portfolios, not only with us in Birla SunLife, but across the industry are managed. So essentially, you could look at hybrid funds debt part as short-term funds. That's what they're likely to mimic.
Thank you, Maneesh, for your views on fixed income. That will help our investors to understand fixed income in a much, much better way. Thank you so much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.